Good morning, everyone. How's everyone doing? Good. So I'm Phil Fogel. I'm the Chief Blockchain Officer, or Chief Crypto Guy for fun, at FlowCarbon. I've been in the blockchain space for about 10 years, and about 5 years ago got into the impact in blockchain space and have sort of never looked back and have sort of gotten deep into the carbon markets, and I'm really excited to tell you about what FlowCarbon is building. But before we do that, just a very quick, I think at this point everyone here has had a bunch of overviews into the voluntary carbon market. I think we spent a lot of time in the last few days talking about carbon and where carbon fits into the blockchain space, but just to do a quick refresh for those who haven't seen it. I always start every presentation with the question, how voluntary is the voluntary carbon market? And the answer that we've started really getting to is that it's not that voluntary anymore. Larry Fink, who is the CEO of BlackRock, has sort of said that people have no place to hide, and decarbonization is something that has to happen at every company around the world. And so the voluntary carbon market is becoming less and less voluntary because of shareholder pressure and the entire ESG movement, which is not going away. So thousands of corporates have made commitments over the last 24 months, and really what's ended up happening is that you see a tremendous increase in the buying of carbon credits and companies who use carbon credits. And nature-based solutions, sorry. Where'd that slide go? Interesting. Okay, anyway, nature-based solutions can make up 30% of the solution to the carbon crisis and keeping the planet cool. And the net zero commitments that companies are making, basically the way they work is you want companies to reduce their emissions. You massively want reductions. That is the key to the game. But some reductions are structural. They're not going to be able to reduce those emissions beyond a certain point, and it's going to take them time to do that. And so what you look at, if you look at this chart, what you're seeing is the path to net zero for some of the largest companies in the United States and the commitments that they've made to get there and how they're going to get there. And so it's basically over the course of several decades, they're going to reduce their emissions down to zero. And then if you look over here, the way that that actually gets achieved is the gross emissions go down, but offsetting also goes down as well. And there is a delta that's always going to be created, and companies that want to get to net zero immediately are going to have to use offsets today, and there aren't enough offsets sort of to go around. So, as I said, nature-based solutions can be about 30% of the solution, and nature-based solutions come from a whole realm of different things that basically are credits that can be issued today. These are credits that we know how to create. There are methodologies that exist for them, and are very easy to sort of implement across the globe by either not cutting down trees, planting new trees, regenerative farming practices, etc. There's lots of other opportunities in the tech world with direct air capture and lots of other things that are coming online, but that's going to take a fair amount of time before those solutions can scale up, whereas the nature-based solutions, we can start scaling them very quickly today. And so the expectation, so how do they get created? Nature-based solutions get created by projects that do things. CO2 gets quantified, sort of if you were here for the Hedera talk, basically the same way that they're doing it with Hedera is now done today by NGOs. Then those project proponents sell the credits, and then corporates buy them to retire them. Demand is sort of skyrocketing across the board. You're seeing this market, which was a $300 million market a few years ago, increase to being a $10 billion market today, on its way to being a $100 billion market, and really go beyond that. Credits in the nature-based space were trading at $3, $4, $5 a little over a year ago. They're now trading at anywhere from $10 to $15 to $20 a credit, and those numbers are going to continue to move up, especially as more corporates make commitments and buy more offsets, and the supply takes more time to come online, right? Think about if you're planting a tree today, it doesn't really start to capture a ton of carbon for a very long time, so you have to sort of, there's still going to be this major supply and demand imbalance. So what does the market look like today? The challenge is that the market is severely broken for buying carbon offsets, right? Today, if you want to buy a carbon offset, you have to basically go from the producer of the carbon offset, which is a project that creates them, to the end buyer, which is a corporate. You basically navigate a web and a maze of consultants and brokers and non-standardized contracts and lots of different fragmented exchanges. Almost all transactions take place over the counter, and it takes weeks and months to settle transactions. So the intermediaries, this is minimizing cash flows to projects, right? At the end of the day, the projects are the ones that are most misserved by this market because they're the ones that are actually they're selling their credits much cheaper than they need to be because the brokers are taking a big spread on top of it. There's no price transparency. Because of the OTC market, no one really knows what credits are trading at. And so even when credits do trade on public markets or are reported, it's a small subset of what actually takes place. So you don't know when, for example, Microsoft or another big company goes out and buys a specific project. You don't actually know what they paid for that project. And so the market has no way of validating, and smaller companies have no way of knowing what the true price is. There's no access for retail institutional investors, and even small and medium-sized businesses are often cut out of this market because it's so complicated to work on this. If you think about Microsoft is one of the leaders in sustainability and offsetting. Microsoft has a team of over 40 people that buy offsets and do research and project-level research into different projects that do offsetting. The largest issuer of carbon credits, Vera, an NGO, has less staff than that. And so if you think about being a small company that wants to do this, you can't go and afford to hire a team of even 1 or 2 people to do this kind of research. So the access to information and the access to the market is severely limited. And the corporate buying cycle is really difficult right now, and so it's really unclear how this market gets moved. So what is the solution for this? Is right now it takes weeks to months to buy credits. There's counterparty risk along the way, because you don't know who you're dealing with, and you're dealing with non-standard contracts. We bought some credits the other day that we actually placed the order to buy them 3 months ago and just received the paperwork to sign off on it. And it involved two different counterparties, one of which they sent the contract over in Portuguese. And so it was actually how do we deal with that? How does anyone who's not a specialist in this market deal with contracts like that? And then there are transaction costs that are really high. Developers, there's huge broker commissions. And so the process that we're creating is to basically build out a marketplace and to build out an infrastructure layer that enables marketplaces to bring these credits online onto blockchain and to basically reduce all of these frictions. The timeline is basically 2 to 3 days, and that is only because once you've sold your credits on-chain, you have the 2 to 3 day delay in getting your stablecoin out of the system. The finality of the sale takes place instantaneously, as just about anything on blockchain does. There's no counterparty risk because you're basically doing this through decentralized exchanges, and the tokenization fee is significantly less than all of the fees currently being charged into the market, and so the developers end up retaining 98% of the value instead of retaining 60 to 80%. So how do we do this? We basically create a system that treats us very similar to the way Circle works for stable dollars, right? So basically what happens is we have an open protocol whereby projects can deposit, or anyone with carbon credits can deposit their carbon credits into a bankruptcy remote SPV. That bankruptcy remote SPV will then issue a carbon token. That carbon token is linked back directly to the project or to the thing that you just deposited. The way that this works, if you want to think about an analogy, is it works the same way a dry cleaning or laundry receipt works. When you drop your dry cleaning off, they give you a little slip with a number on it that you then own, and that basically says that you have a legal right to go pick up your dry cleaning. But you can also pass that dry cleaning receipt to somebody else, and they can pick up that exact piece of dry cleaning. That is the legal structure that works the same way for this token. So when you have the token, you have a claim on something very specific when you have the project-specific token. But then we go one step further, because when you have these project-specific tokens, it's very difficult still to find price discovery because there are so many of them, and sometimes the volumes are very limited, and so you don't really know exactly what the price should be for that token. So what we do then is we create bundle tokens. And we'll talk about our first bundle token and what that looks like in a minute. But those bundle tokens basically are as if you took those dry cleaning receipts that you were just issued and you stick them into a gumball machine. And you're issued a token that you can then use to put into the gumball machine and crank it and get something back out. But it's not something specific. You basically give up the specific right in exchange for access to liquidity, because the bundle tokens will trade on DEXs with very deep liquidity. However, you can always take the bundle token and use it for its utility, which is to retire it, basically claim the offset, or you can redeem it and go back off chain, or you can unwrap it and you can actually pay a fee to basically open the gumball machine up at the top, stick your hand in, and pick out the exact dry cleaning receipt that you want to take out of the gumball machine. So the benefit of all of this is it creates 2 points of arbitrage on chain, right? This is what we call a two-way bridge. And the two-way bridge basically creates market efficiency between the on-chain and off-chain market for carbon credits. I think at this point, everyone here probably believes that all carbon should trade on-chain, but that's going to take a while before that actually ends up happening. So in the meantime, we have to create a system where the on-chain and off-chain markets can interact together and create efficiency and price discovery. And because you can bring credits on-chain and then take them back off-chain, you create these arbitrage opportunities that will keep the price relatively stable. So the first token that we're introducing is the Goddess Nature token, GNT, and it's basically designed to be a corporate grade credit that people can use for offsetting at the simplest level where there's actually relatively deep volume in the nature-based space. So how does it work? It's backed, as I said, our credits are backed one-for-one with actual carbon credits. They are live, unretired credits, and they're deposited into this bankruptcy remote SPV. And so how was it designed? It was designed specifically for investors as well as offsetters. The goal of the GNT design is that it has a 5-year rolling shelf life, which means that credits can be deposited into it from the last 5 years, but after that cutoff point, you can't deposit anymore. Meaning that at the end of this year, you could no longer deposit a 2017 credit into it. You can only deposit a 2018 credit into it. And when you retire the credits, it actually retires the oldest vintage out first. And so what this does is it creates a mechanism where you can lock in a price today for this quality of credit and hold it for a period of time and offset it later. This also works really well for the investor community, which we're trying to encourage to bring capital into this community so that we can send money directly back to projects. Because remember, the system that we're designing is intended to push as much money to projects as possible. And so the more capital that comes into the system, the more of that money that can go back to projects, because projects can sell their credits, sell their output for higher prices, and then go and continue to do more planet-saving work. At the offsetter level, the intention of the product is to create price transparency for someone who does want to do offsetting, and basically to reduce the buying friction down to the lowest possible point. So the other thing that we're doing at FlowCarbon is we're actually going to start building project finance and structured financial products for forward contracts of carbon. And so this actually gets into a little bit more of the banking-like activities that we're going to engage in order to bring credits on chain. And so what we're doing is we're creating pools of capital that are going to go out and purchase forward contracts on carbon. For those of you who don't know how a forward contract works is when a project is closer to issuing but has not yet issued its credits, they oftentimes will go out and say, great, I want to sell my credits now so that I can continue to fund the work that I need to do and lock in a price today. And so what we do is we go out, we buy a pool of these contracts that are basically promises to deliver credits later at a fixed price or at an agreed upon price, and we put them into a pool and we tranche them. And what the tranching does is it basically allows different sets of investors to come into the product, come into the investment with different layers of risk. So at the top of the stack is a senior, and that senior is basically paid a fixed rate of return. You can think of it almost like they're issuing a bond. They're basically buying the debt of this pool. And then there's a junior, and the junior has equity-like characteristics so that they actually can have potentially much higher upside. But the junior will always eat the first losses, so that if for some reason the credits don't issue or the carbon markets go down and you don't get as much money out of the carbon credits as you thought you would, the senior is protected and gets their rate of return before the junior gets paid anything. And all of this is done on chain using a protocol called Centrifuge that basically automates the waterfall of the cash flows so that there's absolute protection for the investors that when the cash is distributed, it's distributed correctly to the different tranches in the pools. And so this is actually a relatively large innovation because this kind of project finance does not exist today for carbon projects in any capacity. Right now, the carbon forward market is a very specialized market that is even more difficult to transact in and harder to transact in than the spot market. And that's really saying something because that's one of the most complicated markets I've ever seen. And so the goal for what we're doing here is to create a way for individual investors as well as institutional investors to invest in this space using a new product. And the other benefit of this is that as we start moving towards more and more on-chain capital being used for the carbon markets and to support the carbon markets, the senior tranche of this is actually a very good investment for stablecoins. And so we are working with the likes of MakerDAO, the Celo Reserve, and lots of other stablecoin issuers to talk about how they can take the senior tranche, lend against it, and put it into their reserves, put it onto their balance sheet as a senior asset that is a very good, stable asset that they can earn a yield on. And so with that, I think I'll open it up for questions if anyone has.